Hello everyone, welcome back to another episode of Finance Agents Live. This is episode number 104. It's just me today, Tim MC, and I'm going to be talking to you about something which might seem a little scary or might seem like something I shouldn't be excited about or we shouldn't be excited about, but really I sort of am, because for us there's a lot of good things about a pending recession. It's going to sound weird, but I'm going to explain that to you in a little bit. As long as you are prepared for the recession, you can make it the best thing that ever happened to your funding business. I know I did it before, and I'm looking forward to doing it again for new reasons this time than even last time. All right, so let's jump into this. First of all, if you go onto the news right now, especially the business news channels, they are all telling you the sky is falling. Now, when is it falling? How is it falling? How bad is it going to fall? Nobody really knows, but just about everybody agrees that we are heading into some rough times for the economy. That is definitely a bad thing for the economy. It's always good when the economy is growing, but it doesn't have to be a bad thing for you specifically. Today I'm going to talk about 4 things related to what happened just this morning. One, I'm going to say what the heck happened. I'm going to talk a little bit about it just so you know what it is. I'm going to be a real general, not get into the specifics of the bond markets or all that stuff, because that doesn't matter. All right? I'll tell you what happened. I'll tell you why it matters to you and how you can prepare for it as first an investor, or how you can prepare as a finance agent or funding broker. And this is all stuff, frankly, I've been waiting for this for years. I didn't think it would take this long to happen. Now that it's here, I am ready for it. You should be too. The good news is, working together, we're all ready for it, and we can help you succeed during these pending rough times. All right, so what happened? Again, I'm going to make this real general, but basically, the government gives out bonds. Bonds are like debt. People buy these bonds from the government in order to get a fixed return. Remember, my grandfather had bonds that paid him like 14% back in the good old days when inflation was crazy. These days, you're lucky to get, 1 or 2% on these bonds. The yield or the payout is pretty darn low. Why? Because everybody believes the government's going to pay their debts. Let's hope they do. All right? But they don't just have one type of bond. They have short-term bonds and long-term bonds. Now, if you were going to invest in something short-term versus something long-term, which one would you require a higher return from? Which one would you want to make more money on? Well, the normal answer is a shorter term something is less risky than a longer term something, because guessing what's going to happen in 2 years is probably easier than guessing what's going to happen in 10 years. So normally the yield or payoff on a short term or a 2-year bond is lower than the payoff on a long-term bond because of the uncertainty. Right now, what happened this morning is that has officially switched. It is now considered riskier to have a short-term bond than a long-term bond. What does that mean? It says, hey, people or investors are freaked out right now. They don't know what's going to happen right now. They'd rather put their money into a long-term thing as a safe haven. Here's a chart. It's a little confusing. Trying to figure this out. I don't know. I've got it there. You can look at it if you want. But what it really comes down to is, for the first time in a long time, those lines are crossing. It is now considered riskier to have a 2-year bond than a 10-year bond. All right? So that is a bad sign for the economy, because people are saying, in the short term, I'm really scared. I don't know what's going to happen. Now, investors are looking for safer places to put their money, and they're more willing to put it into a long-term bet because they say, hey, it might get ugly in the near term, but over 10 years I'm good, so I want to put my money into a long-term safe haven. Now, in general, investors have 2 big buckets of where they put their money. They put their money into bonds for safety, really low return. They're not looking to make much money, they just don't want to lose money. That's bonds. Or they invest when things are going well, or they have a positive outlook on the future. They invest in stocks. The stock is basically ownership in all the companies in the country, and we expect those companies to be doing well. You want to own some ownership, and you're expecting the value to increase. When you're worried about the ownership dropping, you sell your stocks and buy bonds. So every time there's a recession, the stock market goes down and the bond market gets a big influx of capital. Right? And then most economists are looking for the end of the recession for money to come out of the bond market and go back into the stocks. A lot of investors have been making a ton of money with stocks for a long time, and that's great. We have plenty of investors making 10, 15% on their stock investments over the last, 5 years. I mean, we're about 10 years into a recovery. Things have been great for a long time. But, I've had people that for 4 or 5 years now have been telling me a recession is coming soon. Something that's interesting about the doomsday guys who always say a recession is coming is eventually they're going to be right? You probably heard the saying, even a broken clock is right 2 times a day. Well, the same thing, a guy who is telling you that the end is coming or a recession is coming is eventually going to be right because the market moves in cycles, it goes up and down, and you know it's going to happen. Frankly, I'm surprised it's taken this long for a recession to come. It's not even completely here yet, but it looks like it's going to be coming soon. All right, so now I think we pretty safely established, this isn't just my opinion, almost every economist out there says, hey, something bad is happening, it's going to turn around. Is it going to be horrible or is it going to be just a little bump? Nobody really knows, but in general, the people that tend to say, this time is different, are very frequently wrong. So the best and smartest thing for you to do is prepare for the worst. Assume that this is going to be a somewhat bad recession at least, and be prepared for it. Now, at Finance Agents, we have 2 different audiences that we speak to. We speak to investors who invest in our mortgages, which are our private loans that we give out. That's one audience. And the other audiences are obviously finance agents and funding brokers that are out there selling money. And this occurrence or this chain of events has an impact on both parties. And so we're going to be talking about today how to prepare for it for both sides. All right, so first of all, let's talk about investors. As I've been mentioning, if you're an investor, the Coke and Pepsi of investing are bonds and stocks. Stocks, if you think you're going to have a recession coming soon, probably a good time to sell out of your stock portfolios or at least get into index funds or something where your risk is spread across the whole market. But if the market's going down, and it is right now, then you might want to sell relatively quickly. And what are you going to do with that money? Well, as I've already said, you could put the money into bonds, but you went from making 15% to now you're lucky to be making 1.5% or 2% or more. If you're good at bonds, whatever, you might be able to make more money, but it's not going to be that much, right? I mean, if you're lucky, you're making 5% on your bonds, I would say, but you're definitely not making 15%. Well, fortunately for us, and this is something I've been waiting for a while, we have mortgage investing, and our mortgages are not like what created the mortgage bubble of 2007 and that explosion. We're investing at super low loan to value on properties where we're really resistant to a downturn. Well, a lot of mortgage lenders are investing in mortgages hoping that everybody pays. We're investing in mortgages where we're already assuming everybody's going to default, so it really doesn't affect our lending. In fact, we're going to have more people coming to us for loans than during the good times because they get into trouble and the regular banks are going to be shutting down or constricting some of their programs. So as regular lenders are getting turned down more and more for banks, there's going to be a greater demand for the private real estate loans. So for us issuing loans, that's great. On the investor side, this is the best place to put your money, right? You can go from making 15% to 2% in bonds that are very safe, or if you want to make anywhere from 10 to 20% investing in mortgages where you're investing in a mortgage that's only worth half of the value of the property, things have got to get pretty darn bad before there's any risk at all. Even in the bubble or collapse of 2007, 2008, property values almost nowhere did they drop by 50% or more. So investing in a mortgage that's half the value of the property is close to the safest place you can put your money. Obviously, annuities and bonds are even safer, but the return is so dismal that you're basically giving up, rolling over, right? If you want to, this is the best place to go if you want to actually make money during a downturn. We're going to have more and more clients coming to us. We're going to need more and more investors, and the investors are going to be making way more money. Obviously, in the stocks, if you're investing in stocks, you're losing money. I'm just straight up losing money. If your 401k is invested in stocks, you're probably you're going to see that go down. If you're investing in bonds, you're not making any money, but you're not losing any money either. This is a great way to still make 10 to 15, maybe 20% on your investment during a downturn. So for investors, and I know I'm a little bit biased here, but feel free to go look at anything else. You either have losing money on stocks, treading water on bonds, or making just as good of money in mortgage investing as you used to make in stocks, but without any of that volatility risk. So that's a win-win. If you're looking to invest, if you got money, this is the way to do it. Somebody's asking if there's a minimum investment. Yeah, there's really, I think $25,000 is the minimum investment, just because the loans are, our typical loan's about $100,000. We do loans less than that, but I wouldn't want to take a $100,000 loan and break it up into more than 4 or 5 investors. It starts to get too much work, and there's extra costs for the borrower, so it doesn't really make sense. But with $25,000, you can get into just about any mortgage. We have good ones we're doing right now. For example, I'm in the process right now of closing on a loan. It's a $200,000 loan on a property appraised at $1.1 million. It's an 18% loan to value. Obviously there's always a way something can go wrong, but it's pretty darn hard to get hurt when you're investing at such a low amount on a property worth so much, and the interest rate is almost 15%. So that's an example of what you could invest in with mortgage investing. Darren, you got a question?
Yeah, well, I kind of equate it to making a pizza. Like, you can always mess up the pizza, but it's really hard to mess pizza up, or like a grilled cheese. There's all that that's that possibility. I'm hungry right now, but it's pretty safe.
Right. Yeah, nothing's 100% safe, but it's pretty darn good. I mean, look, to go through the options, if the thing burns down, we have insurance. If the guy or gal, the borrower never makes a single payment, we foreclose, and you might end up making way more money. If you foreclose on a property, you put a $200,000 loan, it's worth $1.1 million. Even if you fire sale it at $500,000, you just almost doubled or tripled your money plus fees. It's pretty much the best way to go. All right, so that's my advice for investors. Immediately start pulling out of stocks. Maybe try not to do it right this second. Generally, it's going to dump, come back up, whatever. You work the market however you want. But start getting out of stocks and deciding if you want to put your money in bonds to tread water, or if you want to invest in mortgages. We have amazing ones. We have more deals than investors. We're sending to institutional partners, but I'd rather work with individual investors. That's where I'm investing my money into mortgages. So that's a great option. All right, so that's on the investor side. Okay, Corey's also asking, how liquid is the money? Excellent question. If you invest in a mortgage, you have to assume that you're not going to be able to get that money back for a year or two, right? Generally how it works is you invest, you start getting interest payments right away. There's always a chance that somebody may not make a single payment and you have to foreclose. I'd say on the longest, we foreclose pretty quickly when that happens, but let's say on an outlier, it could take 2 years to foreclose. And maybe you don't even foreclose, then you get the property back and you got to sell it. So it could be 2 years before you're able to make your money back, but in that time period, you have a lot of equity and you can make a lot of mistakes and still get it right. With that said, if you don't like your interest, you can sell it off to somebody else, so you could get rid of it right away. But I always try to say, hey, assume nobody makes a single payment and your money's trapped for a couple of years. With that said, 2 years is a lot less than 10, right? You want to lock yourself into a government T-bond where you make it 2% annualized over 10 years. That's a lot. Of course, you could sell your bonds too, but whatever. You get the idea. I know some other investors invested in a long-term real estate project where they expected their money to be tied up for 10 years. So I take 2 years. It's pretty good. I personally invested in a number of mortgages. I haven't had a single one go to term. One was 6 months. One was only a month. So, I think it's a pretty good way to go. All right, so for finance agents. All right, so we talked about investors. Now let's talk about finance agents. First of all, I want to let you know that this is not the first time I've been through this, right? I got into the funding business in 2008, I guess, the same time as Darren. And right about then, it got, I think, way uglier than we could ever expect it to happen now, right? I mean, obviously, it could be as bad as that now. I don't think it will be. But it got pretty darn ugly, right? So I have seen what happens, and I can prep you for it. The good news is we have products that will flourish during a downturn, kind of like I just referenced with the private loans. All right, so if you are a finance agent or an independent funding broker, whether or not you're working with us, the things you need to start doing is start shifting your focus from mass market institutional products to recession-proof products. Now, that doesn't mean that the big banks are going to completely eliminate loans, although they might, right? They might completely eliminate the product that you're doing so well at. I remember in 2008, 2009, I saw companies where they were doing really well with one product. That product went away and it just put them out of business. So you need to start preparing for the idea that whatever you're offering to people might go away or might change dramatically, right? And the best way to do that is stop focusing on something coming from Bank of America or, like Wells Fargo, for example, completely closed certain segments of business lending during the 2009 or somewhere around 2009. So the product you're offering may go away, and I'll give you some ideas on what those products would be. And try to focus on recession-proof products, and I'm going to give you some examples here in a second. On top of that, expect changes in programs. Even if you're working with private lenders, look, the institutional lenders, private lenders, expect changes, right? Some of those changes would be interest rates could go up, costs could go up, they might eliminate certain segments of people that can get a loan. Expect it. Don't be surprised. And most of all, don't waste even one moment of your life complaining about the fact that something has changed, right? Any time spent complaining about the fact that something has changed is wasted effort. And the people who spend the most of the time complaining are often the last people to actually be able to adapt to it because they're just banging their head against the wall trying to make the old thing work. It's time to change, all right? So expect changes in programs. Bankers, if you're working at a bank, it's time to dust off your resume. I remember from 2008 to 2011, I'm not trying to exaggerate here, at least 50% of the bankers that we knew, and that's on the low side, probably more, swapped banks, right? They got fired from one bank or let go in a layoff. Sure enough, they got hired into another bank. It was like the great migration of bankers. It's just one day somebody be at Chase, the next day they'd be at Wells Fargo, then they'd be at B of A. So while it may be scary if you see layoffs or something, it's probably not the end. You're probably just switching to another bank. Now, that's on the bank side. I remember here in Orange County, mortgage offices, there were so many of them, and they were laying off like crazy, and those people couldn't go anywhere, so they needed to find something else to do. Fortunately, the funding we were doing took off during that time frame. I mean, literally took off. So, if you're working at a bank, dust off your resume, expect to make a switch, or maybe now is the time to go out on your own and open your own funding shop. If your bank is making you work harder and harder and harder, and while making it harder to actually qualify for financing, you might appreciate that salary, but you're going to be making way less on your funding commissions. If instead you want to switch to offering things the banks don't offer, where you can make a lot more money and demand is going to go through the roof, this is potentially the time to do it. All right, so expect demand to increase if you're a funding broker. Now, initially that sounds great, but not always. If you're working at a bank where they're not allowing you to give money out because they're making it harder and harder and harder and making you work harder and harder, this is not just a theory. I mean, this is literally what happens. When the market gets tougher, finance agents and funding brokers will work harder because you're going to have more business. And it's up to you whether or not that is a good thing or a bad thing. If you're trying to offer things that nobody qualifies for or are no longer available, then you're going to work harder and make less money or make no money or lose your job anyway. If you do it right and you can triple your fundings and triple your revenue. For example, Finance Store, the company that we started around 2008 and going right into the Great Recession, we had over 2,000% growth from 2009 to 2012. Is that because the economy was amazing? No, it was bumpy and ugly, and funding programs were gone and disappearing every day. But because we were focusing on products that we could continue to sell through the downturn, then we had massive growth. So again, you might be looking at, oh my God, the recession's coming. How do I prepare for it? Well, the way you prepare for it is offer things that are going to flourish in a recession instead of being angry about it. Instead of putting up a wall for the windstorm, build a windmill, right? Build things that are going to benefit from problems as opposed to be damaged by them. So what are some of those recession-proof products? All right, let's go through a list here. Nothing is 100% one way or another, and I'll talk about that a little bit, but here are some recession-proof products. First of all, 401k rollovers, all right? If you know somebody with money in their 401k, they've probably been real happy with that 401k over the last 5 years. In the last downturn, I saw somebody's 401k get cut in half in a 6-month period. Literally, he went from having $200,000 in investments to $100,000 because the investments got damaged so badly. So, if you have money in a 401k, that might be a great time to get it out and put it into a business. that is the pitch for a client looking for funding. Maybe in the past they were completely unwilling to save their retirement savings, and why would they? They were making great money and it's totally safe. Guess what? It's no longer safe. It's a good time to pull the money out and put it into a business that can grow in a downturn and might completely change their life. So 401k rollovers do not have credit criteria. All you got to do is pull the money out, right? So you cannot be damaged by a downturn unless they wait so long that the amount reduces. But the more it reduces, the more likely they're going to want to pull it out. So 401k rollovers are completely immune to a downturn, except for maybe the fact that they might be worried about starting the business on the other side of it. I get it. All right, so the second product is the one that we as finance store really grew with during the Great Recession, and that was unsecured finance. Unsecured finance is really business and personal credit cards. Now, I'm not saying that it was unaffected. Before the downturn, we sometimes got somebody $200,000 to $300,000 in unsecured finance. When the downturn happened, at one point that average dropped all the way down to $50,000, and you might think, oh my goodness, funding's dropped from $200,000 down to $50,000. That's a dramatic decrease. That's a 75% decrease in revenue. It may sound like it, but it wasn't. People needed money badly. So while before we were only sending up 10 clients a month, we were able to get it up to 50 and by the peak, over 100 clients per month for a product that maybe they wouldn't have looked for before. So while they might have gotten less funding, we made way more money and helped way more people because the product was still available. People got less, but they still got something, while so many other products completely disappeared and there was nothing that they could do at all. So it was a great time of growth for us. All right, revenue advances. Revenue advances have had an explosion over the last 7 years. They've really retracted over the last 2 years. These are those daily payment, super high interest loans, right? People don't really like them that much. They're only good for certain scenarios. But I will say this, when the recession hits, people who never would have accepted 1.3 factor on their money will now be ecstatic to take a 1.5 factor on the money. What I mean to say is people that never would have accepted before at a lower rate will now pay more because they realize this is the only type of funding that exists. There will probably be a contraction in the amount of money available for revenue advances, but just like unsecured finance, it will still be there and people can still get it even when things get rough. So revenue advances will shine during a downturn, even though it's going to be more and more expensive. All right, the fourth thing that I would say is recession-proof would be our private real estate loans. Obviously, we're already talking about it. I expect investor interest to increase. Investors will be coming to us to invest their money because they want to make 15% instead of making 2% or losing money. So we'll have more investor money to give out on these private real estate loans. We're probably going to be a little bit even more conservative, but here's the deal. We have already been underwriting every single loan with the idea that somebody could go into default. Unlike the banks where they're crossing their fingers hoping you don't. So our underwriting shouldn't change too much. What may change is the actual value of the property. While maybe before it was worth $1 million, now it's only worth $800,000. We could still give a loan at 50, 60% of the value. So don't expect that problem to go away. I expect applications to increase considerably. Those are what I consider to be recession-proof products. On the other side, recession-affected products. Now, this doesn't mean you should never offer these products or they're completely going away, but beware, if you're offering these products, you're likely to have an impact. I'll go through each one or talk about it a little bit. There's obviously way more than I'm going to say, but you get the idea. First of all, SBA loans. Now, SBA loans is a little bit of a mixed bag. When things get really ugly, the government boosts the SBA program. You're going to be hearing things about how, oh, the government has done this in order to encourage SBA loans. But the SBA loan is a weird beast. The loan actually comes from a bank, which is going to be affected by a recession and who's going to pull back on who they lend money to. Now, the government may provide collateral in order to encourage the bank to do so. They may waive fees for you in order to encourage you to get an SBA loan, but that bank's still going to want to give the money, and if things get ugly, the banks are going to get tighter and tighter, and they're going to restrict the amount that they're going to give out in SBA loans. It doesn't mean you can't get loans. One thing you're going to see is, again, somebody who, everything comes down to price with loans, right? There's some clients of ours that think SBA loans are at 7% interest are crazy expensive and would never pay for it. Well, 2 years from now, if the recession hits, those same people will be happy to take a 7% loan, and they will still qualify for an SBA loan. That's one of the things that's interesting about being a funding broker, right? When the economy goes up, people who didn't qualify before will qualify for better funding. When the economy goes down, people who never would have asked for funding will be asking for it. There's always a market as a funding broker, and you get busy in the downturn and you can still make money as long as you're offering the right product. So SBA loans will take a hit. Beware of that. Second one, if you're out there giving bank mortgages on owner-occupied properties, frankly, I think these are the people who are going to be hit the hardest, with the exception of if they're offering refinances, you're going to see this big refinance boom where they're going to be offering lower and lower interest rates as the Fed cuts interest rates in order to boost the economy. So if you're a mortgage broker, you probably want to be doing refinances. If you're trying to do purchases, I bet you see a big contraction in that market, and you might be looking for something else to sell. Here is, in my opinion, the number one thing that's going to be hit during a downturn, and that is the fix and flip lending product. Again, none of this means it's going to happen tomorrow. The economists are predicting 12 to 24 months whenever this indicator happens for the recession to hit, so it's going to be a little while. But fix and flip lending, my opinion, is some of the riskiest lending that's out there. You're lending, a value greater than the value of the home in some cases, and it's construction. So if they start a construction project and don't finish it, now the home is actually worth less than when they bought it, and they're expecting these things to flip quickly. If the market dries up, people aren't buying properties, the flippers can't sell them. Once some flippers start defaulting, the fix and flip lenders are going to have to start pulling back, and I think you're going to see a massive retraction in fix and flip lending, probably even more than SBA loans, because at least the SBA, they've got the government to bail them up. Fix and flip lenders are almost always private lenders and private funds, and they've been enjoying incredible returns with very low defaults. That is going to change, and a lot of these guys are going to go out of business. Now, the last one I put on here, I put a question mark next to it. I'm not really sure. Over the last 3 or 4 years, we've seen a huge growth in personal term loans. Now, these are loans that are issued just based on your credit and your personal income. To me, when I see a big growth in a funding product over a 3 or 4 year period, generally that's the one that's going to get hit the hardest when there's a recession. Now, I don't know this for sure, but I predict that of the private term loan providers that have blossomed over the last 4 or 5 years, if we have a real recession, probably half of them are going to go out of business. There'll be some consolidation, and it's going to be harder to get those loans. Those loans right now are amazing. If you qualify for one, get it fast because they're probably going away. Honestly, you can pick them up in 3 or 4 days. The interest rates are low if you have good credit. You could get a 3, sometimes up to a 7-year term. I saw somebody get a couple $100,000 in a week between 2 different loans, and the interest rates were 6 to 7%. If you qualify for a personal term loan and you want to have some long-term financing, personal term loans are great. I say get them now before these lenders go out of business. If there's a recession, I think they're going to be really hit. All right, I see some more comments coming in here. I haven't really been able to look at these. Anything I should be addressing on there? Darren, you reading them at all?
Corey was just asking if we had, I think it's a standard script.
A script for what?
They can publish on social media to promote the option of what we were just talking about. So
being a finance agent or the
finance
investor
agent, probably
investing in
the
loans?
investments.
We don't really have anything for social media on the loans side as far as being investing, but we got plenty of stuff for promoting the finance agent program. So we'll be happy to get that out to you. I don't know who your rep is here. I think it's Andy. We'll make sure that you get that right away. Mm-hmm. Anything else?
Mark just said triple fundings.
Triple. All right, everybody should be tripling over the next couple of years. Guys, I'm not kidding. This is when Finance Store, my prior company, the one that we launched, where I really learned everything. This is when we won the Inc. 500 award 3 years in a row for some of the fastest, being one of the 500. It's 2 years that we were one of the 500 fastest growing companies in the world. The third year was one of the top 5,000. But 2 of those years we had over 2,000% growth. Why? Because things took off when the economy dropped. People really needed money, and because we had a solution that worked, it was great. So if this gets bad, stop focusing on the programs that no longer exist, double down on the programs that will grow and flourish, and you could easily triple your fundings. I mean, triple is, that's easy. I mean, 2,000%. That's a lot more than triple. All right, somebody else is saying, Jerry says, do Texas-based finance agents need to become Texas-licensed mortgage brokers? No, definitely not. We do not offer owner-occupied conforming mortgages. Those are the ones that are regulated by Dodd-Frank. Those are the ones that require you to be licensed. We're not doing those loans at all. We're doing private investor loans to businesses. We don't do consumer financing or consumer lending in any way. So there's absolutely no requirement to become a licensed mortgage broker in order to work with us and refer the deals to our lenders. Anything else in there? I see Andres said the subprime market failed and we all went broke. Yeah, exactly. So interesting, when we talk about our kind of lending, some people call it subprime. I mean, we lend to people who normal lender wouldn't. They would probably call it subprime. But the difference between what we do and the subprime market that exploded is in a bad way in between 2007 and 2010 is the banks were trying to do the institutional lending model for people that qualified for my kind of loan, right? They're saying, hey, we're going to take this guy with horrible credit and we're just going to cross our fingers that the property is going to go up in value. We're going to lend him money, use that loan. Banks lend out money 7 times. They have this tiered system where they lend it out, use it as collateral to get financing, lend it out again. It's a really complicated process. I won't try to explain it to you, but literally every dollar gets lent out 7 times, which means anybody in that little pyramid of 7 defaults, the whole thing can collapse. Banks need like 99% success on their mortgages or it causes them big problems, right? We are not like that. We're doing loans at 50% loan to value. If every single one of our loans went into default, we would not be hurt. It would be a while before we got some payments, but we would not be hurt. The opposite of the big lenders. So when the big lenders try to do their model on risky properties, it fails in an ugly way. But it is not the same for us. We've had times where our portfolio of loans, 30 to 40% of them have been in default at any one period of time. And what do people do? You got $1 million property and a $500,000 loan. Are you going to let that thing go into foreclosure? No. I mean, nobody's that dumb. You go sell it. Sell it. You make some money. Pay off your loan, and you're left with some money. Or you refinance with another lender, right? You find a way to fix the problem. So, we've only had to take a couple properties back, and those ones, when you get in a $600,000 property for $300,000, you sell it, you make more money on the default. So we don't try to get people in a default, but it does not hurt us. It's good for our investors, and we keep having a product when other people are closing theirs off. All right, I think that's it for the day. If you're new to the show, please subscribe. Hopefully gives you some good information today. Next week, we're going to be back with the show that we were going to do today, and that's talking about the cost to open or start as an independent funding broker or to start your own funding company, right? If you want to say, forget this bank, take this job and shove it, I'm going to go start my own business. We work with people all the time. We call them member offices that use our system. But whether you do it with us or on your own, I'm going to be here with Trey, and we're going to talk about the costs that you need to expect in order to be able to do that. And if you're offering the right products, you can flourish. All right, thanks everybody for coming on. Look forward to doing a lot more deals together.